Good morning, Armor Insiders and everybody who has decided to join us this morning for the morning meeting. It's a momentous morning. Hope you all are ready for the show. We are going to be talking about Risk Monitor Red. You're looking at a rising wedge right now. Obviously, the Risk Monitor is red. That's the S&P. We're going to go over all of that. Before we dive into it, please remember what we're doing here. It's a virtual hedge fund. Okay, so we're all bringing our own capital to the table, our own tranche of capital. This is our morning meeting. We're going to talk about how we're going to day trade, what our day trading setups are for today, what our swing trading posture is, and some of the investments that are in the portfolio and how we identify each and change each. But at the end of this conversation, and any conversation like this, you've got to be the smart money. I can't tell you how to invest. I can tell you how I put capital to work, having been doing this for over 35 years now. I'm going to share with you information that makes money. We're going to talk about the institutions that are making markets, and then you have to determine your risk tolerance and your goal and execute your strategy, right? So be the smart money at the end of this. So I'd like to start by talking about our swing strategies, our macro fund. All of it is driven by our algorithms for the top 10 indexes that make up what we call the risk monitor. When the risk monitor identifies massive movement across all indexes, on the buy side, that's risk monitor green. Take a look at the chart right here, okay? All the way back here in November of last year, we had a massive risk monitor green entry point, and it led to some significant gains over a 12-month period. Okay. We have a swing trading program. We've been doing this for 24 months now. We trade triple the S&P when we get that type of entry point. That was entry point number 9. Over 24 months, the portfolio is up more than 120%, simply swing trading the index. That's just the S&P. So what we have when all 10 indexes are telling us risk on, we put capital to work. What's the purpose of the risk monitor? It's to monitor what institutions are doing. And we're going to look at some chart patterns today that illustrate institutional flows of capital. You see, the difference between you and I and institutions is that they're running billions of dollars. And so they can't make a decision today to change their portfolio. They have to make a decision over weeks, over months to change their investment stance. We call that distribution. They distribute shares on the way up because they couldn't distribute them all at once. Market would implode, right? So they distribute it on the way up. And what happens throughout this distribution, the smart money institutions are distributing into strength. And at some point, they distribute so much, it gets so top heavy, the bottom does fall out of the market. And usually they're distributing right into retail, right into individual investors who are still high on the idea that stocks only go up until they get wiped out. Did you see the story recently about Warren Buffett's cash holdings? It's enormous. His cash holdings are enormous. He buys when there's blood in the streets, and he sells when there's euphoria. And he's been dumping large amounts of Apple, as an example, all year, building huge cash positions. I'm going to give you a history lesson, make it real quick. Bernard Baruch, one of the greatest investors of all time in the 1920s, had a huge run in the 1920s and dumped everything in 1928. People said he was an idiot. Market went up for another 6 to 9 months. And of course, 1929 rolled around, and he was the smartest guy in the room and the only guy with cash. Smart money and institutions leg out of the market in the midst of euphoria. Now let's bring it back down to what we're doing. The risk monitor looks at all the indexes, the 10 that we use, tries to identify when it's time to add risk and when it's time to take off risk for the swing trading part of our portfolio. We'll get to investing in a minute. Swing trading, just for all of you to, I think this is important right now. Let's go over this real quick. Day trade, swing trade, invest. Day trading, we all know what that means. You trade during the day, you're in cash at night. I'm going to give you my interpretation of swing trading. Let's don't debate it, okay? This is how, when I say swing trading, this is what I mean. If day trading is something you trade during the day and you're out by the end of the day, swing trading is a position you take and you expect that position, if you're making money, to stay in your portfolio for a series of weeks. And you use daily stops. So at the end of each day, you're checking your stops. Have I been stopped out of this position? And if you trade it correctly, the swing trade lasts weeks. If you're investing, you're hoping that your investment will last in your portfolio for months. And in order to do that, you need to have wider stops, and you use weekly stops. So swing trading's daily stops. Investing's weekly stops. At the end of the day, Friday, is the position below my stop or not? So you let there be more volatility. You try to hold it longer. Okay, those are the three definitions of how we're running money. And I just wanted to say this right now to all of you. You need to figure out what you're really doing. Because some of you talk to me, and I get direct message, you ask me questions. You bought the stock yesterday. It was up for a couple days. Then it came down and you didn't sell it, and I should have been swing trading it. That's not swing trading, okay? Buying something that goes up for a couple days and then you sell, it's not swing trading. I don't know what that is. That's like no man's land. That's no man's land, okay? You buy something, it pops for a couple days. Let me tell you something very important about investing and making money. You've got to ride your winners. You have to ride your winners. I don't care if you're swing trading or investing. If you don't ride your winners, you're never going to make money. So if you chide yourself for putting a trade on, it goes up for a couple of days and then comes back and stops you out, and you get upset about that, and you say, oh, I should have sold it 2 days ago. That's just fool's gold, okay? Because long-term, over an investing lifetime, if you don't ride your winners, you're not going to make money in the market, period. Full stop. So when you take a position, and right now we're talking swing trading, the macro fund, we take a position, we're looking out a series of weeks, we're going to use stops at the end of each day, we're going to raise those stops as we go, okay? But don't get suckered into that feeling of, oh, I should have sold it 2 days ago because it was up. That's not a part of what we do, okay? So getting back to the risk monitor. A year ago, it went green in November, and it led to a huge run at the end of the year, and it was 12 months of a beautiful market, and we traded it a number of times on the way up, and we've had investments that have been in our portfolio that we're long-term on now because we use weekly stops, and we never got stopped out, and it's been a great 12 months. What happened last week was risk monitor red. Institutions have been distributing the market for the last few months. I'm going to show you two charts now. Top two charts of interest that are going to show you chart patterns of classic distribution. The first here is the S&P. We call this a rising wedge. I can already hear Joel saying to me, I said that a couple days ago, a couple weeks ago, I said that. Joel, if you remember, I said to you then, we won't know it's a rising wedge until it breaks down. And then I'll agree with you. Okay? I've seen many rising wedges blow out to the upside. Okay? So I don't get ahead of a rising wedge. Sometimes it wedges and has a blow off top, and then it reverses. But I think it's pretty definitive now You can't argue with that pattern, okay? That's a classic distribution pattern on the S&P. It's been going on since July. It broke down last week. Let me show you another pattern. The semiconductor index. There's massive distribution going on in the strongest sector of the market. Semiconductors have been carrying the market all year, led by NVIDIA. We're going to get to NVIDIA in a minute. Take a look at this chart pattern. It's classic head and shoulders pattern over a series of months. 8 months to build that head and shoulders pattern. Let me say something now, okay? Technical analysis is an art, not a science. It deals in probabilities and statistics. It's not a guarantee. Absolutely, the market could recover here and skyrocket. It happens. Every now and then, the market pulls a rabbit out of a hat. But it's our job to get on the right side of probabilities when rewards worth risk. When you see the leading sector put in an 8-month head and shoulders top, when you see the leading index break down from a classic rising wedge, when you see the risk monitor go red, led by bonds, we're going to get to that in a minute. What I'm telling you today is the reward from here versus the risk isn't right for me. It's not right for my money. I worked too hard for my money. I worked too hard to make money this year. My dad always said to me, if you don't respect money, it will find its rightful owner. Okay? I want the rightful owner to be me. And so right now, risk monitor red means protect capital. It's the worst thing that happens. The market goes up without me for a couple of weeks. So what? I've had a big year. I'll find my way back into the market. We'll get risk monitor green wherever that is, and I'll put capital back to work again. Hey, we have a swing strategy that's up over 120% in 24 months for the S&P. When I get trade 16, I'll put money to work. I don't know if I'll be paying higher than where the market's trading or lower. I don't care. What I know is the risk monitor went red, and I want to protect capital. I think it's poetic that it happens right in front of an insane election and a Fed meeting. I'm going to keep this a political free zone right now. But what I will say about the election is both candidates are talking about major overhauls to the tax base of this country, and the bond players don't like it. We don't know what will actually happen, but the bond players are shooting first. They're going to ask questions later. Take a look at the chart of the bond market. So we have an S&P rising wedge. We have a semiconductor head and shoulder. And before we get off semis, take a look at NVIDIA. We've been talking about NVIDIA and how we've been mapping out the stage bases on this unbelievable run. And what I said to you is this is fourth stage base. Now, sometimes the fourth stage base will work, but the probabilities that a fourth stage base works is a lot lower than every other stage. This is the dangerous stage. This is the stage where a double top sets up. And then we have just something laughable. At the end of the day, Friday, the announcement that the Dow is going to replace Intel with NVIDIA. This has the potential to be the greatest top tick of all time for the guys who run the Dow 30 index. The greatest top tick of all time could be NVIDIA right here. This thing is priced to perfection, guys. And they have a 10% customer. Don't forget, NVIDIA's revenue is packed into a handful of customers. It's the Achilles heel, really, of NVIDIA, the NVIDIA story right now. They only have a handful of customers doing all the business. And a 10% customer is in the midst of an accounting fraud. Okay? It's in the midst of an accounting fraud. Super Micro is in the process of imploding. And I can hear the people now telling me not to worry about it, and it's just a misunderstanding, and they'll work it out, and blah, blah, blah. And I heard all of that on Enron to zero. And I heard all of that on WorldCom to zero. And there's so many stories like that in my career, all the way to zero. Look, probabilities, I don't know. Maybe they'll figure it out. Maybe Ernst & Young, their accountant who got up and left, okay? Maybe their auditor who left. Maybe there's nothing wrong there. Come on. Where there's smoke, there's proverbial fire. So we have NVIDIA being added to the Dow at a time where one of their 10% customers is in the midst of, at the very least, a serious accounting problem. And then there's the second thing, don't forget. Price to perfection has to hit unbelievable revenue targets to keep this train going. And there's a memory shortage brewing. There's a bottleneck brewing. Do the research. I don't have time to go over it with you right now. There's a bottleneck brewing. It's why I have an interest in owning Micron, if I can get my way into it and the risk monitor changes to green. That's a bottleneck. NVIDIA is begging the memory guys to pull forward and speed up production. And if they can't hit that, NVIDIA is not going to hit the unreal revenue numbers they're talking about. I'm just saying, guys. This is just all classic. Let's go look at bonds, because this is really what bothers me the most, okay? Bonds lead stocks, and bonds are in the process of breaking down. This morning, Treasury bonds are up almost 2%. So TLT is going to open higher this morning. And hopefully, boy, I'm hoping Treasury bonds find a bottom in here. Okay? At some point, you would expect money to flow into Treasury bonds as they flow out of equities at some point. Cratered on Friday on huge volume, up this morning. Gap ups Monday morning, notoriously treacherous, but we'll see. Only last week I was saying to you guys, I'd like to buy long-term Treasury bonds. I couldn't believe they got destroyed on Friday on a weak non-farm payroll number. Bonds lead stocks. Bonds have been leading stocks for weeks now. The market levitates higher. Treasury bonds have been collapsing. Yields have been skyrocketing. Market can't take that forever. It can whistle past the graveyard for a while. Here's high yield debt. High yield debt broke down aggressively on Friday, really Wednesday, Thursday, Friday last week. Okay. Sure, they're still in the uptrend. It has to follow through the downside, but that's some serious selling in high yield debt. And that should worry anybody who likes equity. High yield debt leads equity. So these are all chart patterns that look like tops, that look like breakdowns. We have a lot of action this week. We have elections. We have Fed meetings. Who knows what's going to happen? What I do know, when the risk monitor turns red and I see all this, it's a time to protect capital. It's not really that hard. It's not that hard. It's just that very often investors get afraid they're going to miss something. You know, they get told over and over, the market always goes up. Yeah, over a long period of time, the market goes up after periodic 50% collapses that wipe people out, and then it goes up. Right. So my job with my swing capital is to make sure I'm not caught in the collapse. Right. And then I get to take advantage of that collapse. That's how you outperform. So right now, the swing capital, risk off. I'll be day trading a lot of capital now. Right. I day trade more when I have a lot of cash in the portfolio. Long and short the market. We were short across the board on Friday and made money on all of it. Made money trading VIX, book that profit. So I'll be looking to go long and short today. Let me tell you how it works for me on my trading desk when I'm day trading. The market opens higher and takes off. I'm looking to short that. If the market opens lower and craters, I'm looking to buy that. The market opens flat, I have to wait for a movement one way or the other, and then I'll look for opportunities. First thing in the morning, we're going to set up our locations of where we'd like to trade. There's key locations every day. When we get down to those locations or up to those locations, we look for trades. Basically, we're mean reversion trading, right? So we get away from the mean. I'm looking to put shorts on back to the mean, vice versa. Okay, so I'll be doing that. Our investing portfolio, hey, it's been having a pretty good week, right? There's a lot of stuff in the portfolio that keeps going up, okay? We own Altria in that portfolio. Had a huge week. Gilead keeps climbing higher. Okay. Bristol Myers had a pretty good week. These are some of the things that are in our investing portfolio. I think AT&T, did it close at a new high almost off of our run? We've owned it from back here. So the investing portfolio, we don't touch. I don't make a lot of movement there. Every week on Friday at Friday at 3:30, I look at my investing portfolio below the stop on a weekly basis out. If not, I hold it. It does not follow the risk monitor. So it's different styles of management that create the diversification and protection we look for on our virtual hedge fund trading desk. So those are my thoughts for today. Any questions you got, let me see them. Throw them into the comment section. I'm happy to ask. All right, let's talk about the cannabis couch. I see a couple questions on weed. What do I think about cannabis? And feel free to put some questions in the comment section. I'll go with you for a little bit longer here and answer anything you got for me. Okay, so for those of you who don't know us on this desk, we have built a large position in IIPR. I told you in February this would be the best way to play cannabis all year. And it's hands down, there's nothing better than IIPR. It's been killing it for us, and we've been picking up a fat dividend the whole way. And what I said to you was I was taking the dividend recently. I said to you I was taking the dividend and buying MSOS calls, okay, right in here in the green box. It popped up. Calls were up like 70% that day. I said to you, I'm looking for 700, not 70. I'm not selling them, okay? Came back down. I took the position off. I made a couple of shekels. I took it off, made sure I got paid for my effort. I'm looking to put those calls back in the portfolio. I think that sell-off there might be a gift, right? Because it had to do with the DEA, that stupid DEA meeting that's supposed to happen in December, and they pushed it out till January or February or who knows when, right? And so everyone panics out of the stocks. But if they find support right here, I'm going to be using this weakness to build up my call positions again. I owned January calls before. This time, I guess I have to go to March, you know? But I'm talking about way out of the money, lottery ticket stuff. And I've earned the right to take that risk, right? I'm taking what is large gains in IIPR for the year with fat dividends, and I'm just taking some of those dividends and I'm buying calls. I've earned the right to do that. That's what I'm doing. And I'm trading the calls, right? So when they pop, I'm holding it because I'm hoping there's something big coming. If they roll back over, I get out with a small gain, make sure I get paid for my effort, and then I look to put them back out again. Okay? Of course, we've got Florida and the vote. I don't know if it's that big of a deal, I'll be honest with you. I know it might swing the stocks one way or the other, but I don't really think it's a game changer. It's not really a game changer, in my opinion. I could be wrong about that, but do I think it's going to pass? You're asking me if I think it's going to pass. Oh God, I don't know. I think it's going to pass, but I don't know. I mean, the Florida governor's out here, pounding away against it for ridiculous. Look, I like DeSantis, but there's a clear conflict of interest, right? You got the hemp industry and apparently he's in their pocket because what he says doesn't make any sense. He's not saying anything that makes sense on cannabis. So anyway, I don't know where it's going to fall. And I don't know if I care. I mean, I live down here in Florida. It's not that hard to get a medical card. You can go buy all the weed you want. Like, I don't know what the big deal is. I don't think it really changes the game that dramatically one way or the other. And obviously, I think it would be a great thing because it takes it out of the black market and puts it into a store, just like alcohol. I mean, there's liquor stores, there's cannabis stores, and get it off the street. I mean, I think that's a no-brainer. I would hope people would vote that way. Everything I'm looking at, it looks like it's going to pass, but who knows? You know, who knows? I'm not short selling NVIDIA. You know, I don't know if that was a question or just a comment. I want to. God, I want to. I really want to short sell NVIDIA, but shorting is something I never recommend for individual investors. Okay. So let me just be clear on that. I day trade short, and it is true that I've got some shorts out right now that I'm holding overnight for swing trading purposes. Okay. Which means I don't cover them just because the market's going down for a day. I got to really stress that, guys. Don't call yourself a swing trader because you buy something and sell it 2 days later. That's not a swing trader. I don't know what that is. You're in no man's land. You've got to get away from that habit. That's just gambling. You put on a swing trade, you look at your stops, you look at your targets. When you get to a target, you can book a profit and raise your stop, but you have to have a strategy you execute. I don't want to go over that again, but it is very important. Okay. So anyway, cautionary tale on short selling. I want to save you the pain. Okay. Most people should not short sell. There is nothing worse than being caught short. It is so mentally bankrupting when everybody else is making money and you're losing it. I mean, it's just like your head is exploding. It's hard enough to get long and make money. But when you get short and the market goes against you and everyone's having tons of fun and you're losing money, you know, it could literally blow your head off. So, and then what it ends up doing is screwing up all your other trades, right? God forbid you're short, the risk monitor goes green and you can't cover the short and go long on the same day. I've lived through that. So I want to save you that pain. Okay. That's a real mind-numbing situation. It's very hard to be short. It goes against you. The risk monitor goes green. You cover your short and you have to get long the same day. And it's very mentally taxing to make that decision. So I don't recommend anybody short. What I'm showing you are charts that dramatically increase the probability the market's going lower. It's not a guarantee. So now's the time to protect capital. Getting out on a limb short is not protecting capital. It's taking a lot of risk. So the call for me right now, and for the vast majority of assets I manage for others, is to hold a lot of treasury bills and be patient. We'll get another entry point. I can't wait for trade number 16. And I'll get long triple the S&P again for a swing trade. And when that happens, I'll start looking for other individual stocks to put into my portfolio again. But until then, no trades in my portfolio. Lots of cash. Day trading, I'm happy to do long and short. I do personally have some shorts out that I'm swing trading, but I don't recommend it. Now's the time to be patient. There's a lot of insanity going to happen this week, from elections to the Fed meeting. I'm not telling you something that really requires, a rocket scientist's, mind to figure out, right? I think it's poetic that the risk monitor went red right before what really is 2 months of insanity. I think it'll be 2 months of insanity, by the way. We were getting long. The last risk monitor entry point was in September. And everyone told me then, terrible time to put money to work, right? Stock Traders Almanac, it's awful. September, October, the worst 2 months of the year. All right. Our trading strategy made us over 12% during those 2 months. But what I think it really did was pull forward the gains from the normal November, December rally. Normally, you want to be long November, December. It doesn't look like that this time around. Like the market looks kind of flipped on its head right now. So any other questions? If not, I'm going to hop here and start our live desk. I appreciate you all spending time with me this morning. I appreciate you all spending time with me this morning. I wish you all the best of luck in your investing endeavors. Everybody try to keep a cool head out there. I think it's going to be insane till the end of the year because I don't think either candidate is going to accept what happens. And so we're going to be going through a lot of uncertainty between now and the end of the year. So you're on your own now. Armor Report subscribers, you can always put a question, comment into this video. I'm happy to answer it during the day. You're on your own. Armor Insiders, 9:30, we'll get the live trading desk started. We'll look for our day trades. We had a great day trading. We had a great week trading last week. When the risk monitor goes red, it usually means volatility spikes. And so there's long and short trades that we hop on all day, and they can lead to a very profitable week. So that's why I usually trade more capital during a risk monitor red period, because there's so many opportunities as the volatility goes up. But we'll be doing that all day. Armor Insiders, we're doing our research, looking for new ideas that we want to put on our whiteboard. So when the next risk monitor green happens, we already know where to go. So we'll talk about some of those things. And of course, guys, look, Armor Insiders, Armor Report subscribers, you have the right to pick up the phone and call me. I'm happy to chat with you. If you need one-on-one kind of sounding board, I'm happy to do it. Give us a call, 561-575-6832. Happy to chat with you. Okay? Everyone have a wonderful trading session. And remember, at the end of the day, only you can be the smart money of your own assets.